Hey everyone, welcome back to Corporate Decoder, the place where we decode corporations. Today we are diving into the Permanent Portfolio Family of Funds report. And trust me, this one's like a financial roller coaster, mostly uphill, but with a few unexpected dips that might make you clutch your investment seat. This isn't your typical company, it's a management investment company, meaning they manage a variety of portfolios. Think of it as a financial superstore. The report covers their performance up until January of 2025. Right off the bat, it covers reports to stockholders. That's you if you own any part of these funds. This shareholder report covers several portfolios. Let's go through some of the share classes. We have Class I, Class A, Class C. Let's see how the permanent portfolio performed. This fund has Class I shares with the ticker PRPFX. So how much does it cost to be in this club? The table shows the costs on a hypothetical $10,000 investment. For Class I shares, it costs $91. If you had 10 grand invested, that's all you would have paid. Or expressed as a percentage, it is L.81%. What drove the performance? The fund aims to preserve and increase the purchasing power of its shares. The strategy: invest in gold, silver, Swiss francs, real estate, natural resources, aggressive growth stocks, and dollar assets. Let's see those returns. Here are the average annual total returns. And let me tell you, these are pretty good. The 1 year return was 24,555. Not bad at all. The TEPSI 3-month US Treasury Bill Index, which only returned 536% for the year. The S&P 500 came in at 26.38%. Let's get a bird's eye view. The portfolio's total net assets were over $4 billion. It has about 180 holdings. Total advisory fees were almost $27 million. Portfolio turnover was about 22%. Next up, let's check out the short-term treasury portfolio. How much to ride this ride? The costs of a $10,000 investment will only cost you $66. The goal of this portfolio is to earn high current income, but with safety and liquidity. They invest in US Treasury bills, notes, and bonds. Let's dive into the returns. The 1 year return was 4.05%. The 5 year was 1.02%, and the 10-year average was 0.73%. Now compare this against the ETSI 3-month US Treasury Bill Index. Its 1 year return was 5.36%. Now, let's get a bird's eye view. The total net assets are a bit over $13 million. There are 10 holdings. The total advisory fees paid out were about $77,000, and the turnover rate was 67.72%. Moving on, it's time to check in with the versatile bond portfolio. What's it going to cost you? On a hypothetical $10,000 investment, it will cost $67. The objective here is to earn high current income, primarily from bonds. They can invest up to 20% in other securities like preferred stocks. Let's peek at the numbers. The 1 year return was 5.43%. The 5 year was 3.0%, and the 10-year average was 3.0%. Let's compare this to the index, the Bloomberg Global Gap, which yield percent. Let's get a quick overview. Total net assets are a bit over $98 million, which is a fair bit. They hold 78 investments. Advisory fees here top $600,000. The portfolio turnover rate was 40%. And now the grand finale, the aggressive growth portfolio. How much will that set you back? It will cost $150. This fund aims for high long-term appreciation, so it invests in stocks that are expected to grow faster than the overall market. Now for the performance numbers, the 1 year was 47.33%, 5 year 21.38%, and 10 year 14.00%. Compare that against the Dow Jones Industrial Average, which only returned 18.93%, and the S&P 500, which returned 26.38%. This is a pretty big difference. Let's summarize the key data. Total net assets are around $57 million. They hold only 35 investments, which is a lot less than other portfolios. Total advisory fees were under $500,000. This fund had a very low turnover rate of 2.54%. Okay, so there were a few items: Code of Ethics Audit Committee, principal accountant fees, proxy disclosures, and controls and procedures. Let's briefly touch on those. First, the report confirms they have a code of ethics for its top officers. It's like the financial world's version of a do the right thing pledge. You can find this on their website. Then the report discusses financial expertise on their audit committee. Turns out they don't have a designated audit committee financial expert. However, they believe the current members have enough know-how to handle things. The auditor didn't come cheap. The audit fees were $135,100. Tax fees were another $16,000. The report also says that the audit committee needs to pre-approve these services, and all was according to plan. The document confirms no significant issues here, stating it followed procedures. Lastly, the company's president and treasurer say that the company's financial controls are effective. Basically, all the checks and balances are working as they should, and there have been no major changes to their internal controls. Now, let's zoom out and look at the big picture. The permanent portfolio as a whole is positioned well, showing solid returns and massive assets under management. While the aggressive growth portfolio has higher returns, its small size makes it a smaller overall contributor as interest rates change. The short-term treasury portfolio might be interesting. Overall, the numbers are above their benchmarks. Thanks for sticking around. If you found this breakdown useful, hit that like button and subscribe for more corporate deep dives. What company should we decode next? Drop your suggestions in the comments below.